Hi, I'm Mary Dittman from Francis Marion University, and today we're going to look at how the Federal Reserve uses interest rates to slow the economy. The Federal Reserve, also known as the Fed, was created in 1913, and it is responsible for regulating the banking system in the United States and for managing the cycles that our economy will go through. Well, what is an economy? An economy is the system by which a society allocates its resources. Every society has resources, natural resources like land, human resources, people and labor, financial resources, and we're going to take those resources or inputs and transform them into an output. The output should have value and be something that people or other nations might want to purchase. That output is called gross domestic product. Gross domestic product, or GDP, is the value of all the goods and services produced in the country. And we want GDP to be high because we're in a market-driven economy. That means that producers only produce things and services that we will consume. Manufacturers don't build new cars for them to sit in a warehouse somewhere. They build cars because they anticipate that we will purchase those cars. So we want to keep GDP at a high level because that means people are purchasing, they have the money to buy things. Therefore, manufacturers and providers are producing, and that will be your increased or your high GDP. GDP goes through ups and downs, and we call that the business cycle. When GDP is high, that's called a peak. When it declines, that's known as a contraction. Now, if you stay in a contraction for 2 consecutive quarters or 6 months, that is known as a recession. If the economy spends a prolonged amount of time in that downturn, that is a trough or a depression. We have not had a depression in the United States since the 1930s. And when GDP starts to rise again, that is known as recovery, bringing us into a time of prosperity and hopefully to another peak. While we want GDP to be high, there is a problem. I guess we could say that every silver lining has its cloud. When GDP is high, that means that we start to have inflation. Inflation is a general increase in the prices. If GDP is high, that means people are buying things. They're buying things because they have money. And the more money we have, the higher prices that we're willing to pay. And of course, suppliers will sell us at the highest price that we're willing to pay. So when GDP is high, we're spending, producers are producing. That leads to price inflation. Some inflation is good because some price inflation means higher wages. However, you can reach a point in your economy where inflation actually outpaces earnings. In other words, the prices of goods and services increase faster and higher than people's incomes. And what starts to happen then is that now I don't have enough money to pay the higher prices. Some economists actually say that a tip-off for a recession can be inflation in food and gas prices. Because what happens is people see an increase in food and gas prices. They start to shrink back on their spending because they're worried that they won't have enough money for food and gas. When we shrink back on our spending, again, a market-driven economy, if we're not buying, producers aren't producing. If we're not producing cars in our factory, we don't need the people there. We'll lay them off. So Too much inflation leads to a contraction phase, which is not good for the economy. So it's really a balancing act for the Federal Reserve to keep us at a reasonable level of inflation, to keep us in prosperity without inflation going too high. The way that they will do this is they'll actually raise interest rates in order to slow the economy. When interest rates are high, it makes borrowing unattractive. 70% of the U.S. economy is consumer driven. That is individuals and businesses, not government spending. So when the interest rates go up, I don't want to go borrow money and buy a new car. When interest rates are high, it's too expensive to borrow money, so therefore I don't want to buy anything. However, if a high interest rate doesn't make me want to spend, it will make me want to save. When I'm saving my money and not spending it, then I'm sending a message to manufacturers, I'm not spending my money. When consumers stop spending, suppliers lower their prices to try to make us want to buy things. For example, if I want to purchase a new car, but the cars are pretty expensive, I go to the bank. But I find out that I'm going to have to pay, let's say, 7% interest on my car loan. That makes me say, I don't want to borrow $20,000 right now. Therefore, I will not buy a car at all. When consumers make that decision, manufacturers say, wait a minute, people aren't buying anything. Let's lower the prices and see if they would be willing to purchase more at a lower price. That is how raising interest rates can actually slow down the economy, which could be good because it will keep us at a 2% inflation rate, which allows people to purchase goods and services and keep GDP stable without tipping off inflation that could actually point to a contraction. We actually do want some inflation. Again, we usually try to keep inflation at around 2%. And the reason for this is that it protects us against something called deflation. Deflation is a fall in prices, which on the surface sounds pretty good. But a fall in prices leads to a fall in wages, meaning when the prices come down, your paycheck gets smaller. And when your paycheck is smaller, you will purchase less. And again, that will tip an economy right back into a contraction, recession, possibly a trough. In this video, we looked at how the Federal Reserve uses interest rates to slow the economy. Make sure you watch the video that explains how the Federal Reserve uses interest rates to stimulate the economy.